Okay, let's unpack this. I want you to just imagine the ultimate investing fantasy for a second.
Oh, right.
You are holding a crystal ball, and this crystal ball tells you exactly when to step out of the stock market so you can dodge the most, gut-wrenching, terrifying crashes.
Yeah, I mean, it is the dream every single investor has, right?
It's
Especially when the news cycle turns dark and things start looking bad.
Exactly. And today's deep dive is pulling from this just massive stack of quantitative research. We're talking about analyzing 99 years of daily stock market data.
Which is a huge data set.
Huge. And it's all to answer one specific question. Can we actually build a mathematical model that achieves this fantasy?
Right, because on paper at least, the math of dodging crashes is incredibly seductive.
Oh, it really is. Like if you look at the broadest index of the U.S. stock market from 1926 all the way up to 2024, a simple $1 buy and hold investment grew to about $6,900.
Which is a great return on its own.
Yeah, but if you had that crystal ball and you magically dodged just the worst 2% of days over that entire 99-year span, that single dollar explodes to $1.6 million.
Wow. Yeah, the asymmetry there is just staggering.
Right.
It is exactly the kind of math that, launches 1,000 hedge funds. And what makes it even more tempting is what we call the theoretical error budget.
The error budget, right. Explain that for a second.
So the numbers tell us that to simply match the baseline market return, you don't even have to be a perfect market timer. The rules of the game are actually, they're incredibly forgiving.
Like how forgiving are we talking?
Well, for every single negative 2% day you successfully avoid, the math says you can afford 33 false alarms.
Wait, really? 33? That is wild. Let's put that into perspective for the listener for a second. You could literally sit out of the market just hiding in pure cash for 150 trading days a year.
Yeah, basically.
That is more than half the trading year. You could just sit on the sidelines experiencing the absolute psychological torture of watching all your neighbors get rich in a bull market, checking your portfolio app every single day to see zero movement.
Which is miserable, by the way.
Totally miserable. But as long as you successfully sidestepped that one catastrophic day, you would still break even with a strategy that just held the stock the whole time.
Exactly. The margin for error seems just massive. I mean, it feels like you could just build a decently sensitive warning system and coast your way to absolute generation-defining wealth.
But I mean, there has to be a catch.
Oh, there is a massive catch. And it's where the whole theory just hits the absolute brick wall of economic reality.
Okay, Leone.
The market fights back against this strategy.
Yeah.
And the mechanism it uses to fight back, well, it's that crashes and rebounds actually share the exact same address.
The exact same address.
Right. We have 99 years of daily data.
Yeah.
And when you look at the 10 worst days in the entire history of the U.S. stock market, 9 of them had a top 10 best day within just 2 trading weeks.
Wow. So they sit right next to each other. They basically hold hands in the dark.
That is the perfect way to visualize it, honestly. The financial industry loves to scare you with that phase statistic, right? The one that says if you miss the 100 best days over the last century, your compound annual growth rate drops to a miserable 3.5%.
Right. You hear that one all the time.
But there is an inverse to that narrative. If you somehow have the foresight to miss the 100 worst days, your annual return spikes to an incredible 16.4%.
Okay, but no one is perfect.
Exactly. No one is perfect. So what if your timing strategy is just, a little sloppy? What if you accidentally miss the 100 best days and the 100 worst days?
What happens then?
Your return drops to 9.98%.
Which is basically indistinguishable from the 9.5% buy and hold baseline.
Barely a blip of a difference.
Okay, so the math says timing the market should be the easiest way to get rich. But the clustering mechanism, the fact that the best days are glued to the worst days, says it is functionally impossible. So what happens if we try anyway? What happens if we build the ultimate, honest, modern predictive model to try and thread that needle?
That is the big question.
And that is our mission today. We are taking 99 years of data to see if a world-class predictive engine can actually catch the crashes without accidentally catching the rebounds.
And, to do this right, to make sure it's an honest model, we have to prove we aren't just looking backward and cheating with hindsight.
Because that happens all the time in these back tests, right?
All the time. In data science, it is very easy to build a model that perfectly predicts the past. So the researchers built what is called an expanded ridge model.
Okay.
They feed it 99 years of broad U.S. stock market data, and they enforce a very strict rule. The model only ever learns from what has already happened.
Meaning, if it's trying to predict a crash in 1987, it knows absolutely nothing about the dot-com bubble in the year 2000.
Exactly.
It is completely blind to the future, just like a real investor sitting there in the 80s would be.
Precisely. They give it a 10-year warm-up period just to learn the basic ropes of the market. And then they force it to rebuild and refit itself every single year from 1936 to 2024.
Okay, so it's constantly adapting.
Yes. And they don't just feed it basic price data either. They gave it 30 distinct mathematical features.
30?
Yeah. It looks at how far the market has fallen recently, the asymmetry of recent returns, which quants call skewness, and extreme outlier price movements, things like that.
Wait, let me jump in here and push back on this for a second.
Go ahead.
We already know that volatility clusters. We literally just talked about it. When the market gets choppy, it tends to stay choppy for a while.
Right.
So isn't this massive, highly complex 30-feature mathematical model just doing what a basic volatility gauge does? Like, are we just building a ridiculously expensive thermometer?
What's fascinating here is that the researchers asked that exact same question. They wanted to know if they were just overcomplicating it.
Yeah.
So they tested this 30-feature model against simple single-feature volatility models.
Okay, and how do you even grade that?
Well, the standard way to grade a model's predictive power is its accuracy score, which is known as the area under the curve, or AUC.
Got it.
To give you a baseline, a purely random coin flip gets a score of 0.5.
Okay, so 0.5 is pure chance. Just guessing.
Yes. Now, a basic model one that essentially just assumes today's market chop will look exactly like yesterday's gets an accuracy score of about 0.56.
Not much better than the coin flip.
No, not really. And even if you upgrade to the heavy-duty, highly complex mathematical models that Wall Street relies on to forecast volatility, you only bump up to about 0.58.
So even the Wall Street standard is better than a coin flip, but really not by much. It's just sort of inching past randomness.
But our 30-feature model, it achieves an accuracy score of 0.747.
Oh, wow.
Yeah. In the world of financial forecasting, that is a genuinely impressive predictive engine. The feature engineering, really looking deeply into market drawdowns and the asymmetry of risk, it adds real, measurable signal above and beyond just knowing that the market is currently volatile.
That's, to put that into perspective for the listener, predicting daily stock market movements is usually like trying to guess the exact number of jelly beans in a massive glass jar from a mile away. You're usually going to be completely, hopelessly wrong.
Absolutely.
So a score of 0.747 means our model isn't just wildly guessing. It actually cracked the code on volatility. It can legitimately spot the weather changing.
It absolutely can spot it. But, and this is crucial, having a good weather forecast doesn't automatically mean you know how to make money off of it.
That's a good point.
We need to see how the model performs when we actually attach real dollars to those predictions.
Because knowing a storm is coming is entirely different from knowing exactly when you should board up your windows.
Exactly. Which brings us to the concept of thresholds, or what data scientists call operating points. Every single day, the model produces a probability.
Okay.
It might say there is a 10% chance tomorrow is going to be one of the worst 2% of days in history. But as the investor holding the portfolio, you have to decide your own risk tolerance. How confident does the model need to be before you pull the trigger, sell everything, and move your entire life savings to cash?
And that's the million-dollar question. If the model is only 5% sure tomorrow is a crash, do I sell? Do I wait until it's 20% sure?
Let's look at the actual wealth paths generated by this model over the out-of-sample window from 1936 to 2024.
Okay, let's see the results.
Let's start with what we'd call the natural crash predictor threshold. Think of this as the sniper approach.
The sniper, okay.
You only pulled the trigger when the model flags the top 1% of the most dangerously volatile days. You are keeping your standard extremely high, meaning you only step out of the market about 2.5 days a year.
Honestly, that sounds absolutely perfect. You dodge the absolute worst catastrophic days, but you stay fully invested and compound your money the rest of the time.
So how did the sniper approach do?
It loses.
Wait, it loses?
It loses. At that precise surgical threshold, the strategy actually underperforms a simple buy and hold strategy by 0.28% per year.
Oh, man. And that is before we even charge you a single penny in transaction costs or taxes for moving your money around.
Wow. Okay, so the surgical strike completely fails. It actively bleeds money. What happens if we lower our standards? What if we decide to be a little more paranoid and react to more of the model's warnings?
We tested that too. We looked at a much more aggressive threshold. Instead of just flagging the top 1% of days, you flag the top 20% of the most dangerous days.
Okay.
This means you are sitting on the sidelines in pure cash for about 50 trading days every single year.
That's a lot of time out of the market.
It is. But at this highly paranoid threshold, the strategy decisively wins. It generates a positive 3.35% excess annual return over buy and hold, and that's assuming zero transaction costs.
Let me make sure I'm wrapping my head around this. To catch the sniper, our model forces us to wear a heavy bulletproof vest and hide in a bunker for 20% of the entire year.
Yeah, that's a good way to put it.
It is not a surgical strike anymore. It's a completely blunt instrument. By sitting out 50 days a year, the strategy only actually makes money when it abandons the dream of being a true crash predictor and morphs into a very broad, very defensive volatility targeting rule.
That is the core reality of the math. It works, but it fundamentally changes what game you are actually playing. You are no longer timing crashes, you are just avoiding general volatility.
Right.
And this naturally raises a deeply important question. Is that 3.35% win at the aggressive threshold actually a real reliable edge? Or is it just a statistical mirage?
Right, because if you torture 99 years of data long enough and you test enough random series, eventually something is going to look like a brilliant strategy just by pure dumb luck. We need to run this through a statistical gauntlet to see if the model is actually smart or if it's just lucky.
Exactly. So we subjected it to 4 brutal, rigorous tests. First, we ran what's called a block bootstrap, paired with a rigorous statistical significance test.
Okay, what does that mean in plain English?
Think of this as a multiverse stress test. We take the 99 years of actual market data, chop it into 60-day blocks, and randomly scramble those blocks thousands of times to create alternate histories of the stock market.
So like Dr. Strange looking at millions of alternate realities. If we reshuffle the 1970s stagflation and the 1990s dot-com boom, does the strategy still survive?
Exactly that. And across 1,000 alternative stock market universes, at that aggressive threshold where you hide in the bunker 20% of the year, the strategy beats buy and hold 99.9% of the time.
Wow.
Yeah, the statistical significance is off the charts. It is incredibly robust.
But what about the sniper?
Right. When we test that surgical sniper threshold, the one that only tries to dodge the true isolated crashes, it only beats buy and hold in 22.8% of the alternate universes.
22.8%. A literal coin flip is twice as good at protecting your portfolio.
It can really...
And we have to tie this back to the core mechanism we discussed at the very start of the deep dive. The reason the precise sniper fails so spectacularly is because crashes and rebounds share the same address. Trying to surgically dodge the absolute worst day mathematically guarantees that you are going to accidentally miss the absolute best day right next to it.
Yeah, the precision is exactly what kills the returns. It completely falls apart.
Okay, but here's the glaring issue with everything we just talked about. If I'm an average investor in, say, 1950, I don't know that sitting in cash 20% of the year is the magic number.
Right. You wouldn't.
I don't have the benefit of hindsight to look at a century of data and pick the optimal bunker strategy. So if our model has to blindly guess the best threshold year by year as it moves forward in time, does it still hold up?
That is the ultimate test of reality, which we call walk-forward optimization. At the end of every single year, we tell the model to look only at the past data it has available to it in that exact moment and pick the absolute best threshold for the upcoming year.
So it's constantly dynamically adjusting based on what it's actually lived through. What did it choose?
Here is the incredible twist. Across nearly 90 years of out-of-sample blind testing, the historical data never once picks the surgical sniper threshold. It never even gets close.
Really?
Yeah. The historically optimal choice, the one the data consistently points to year after year, averages out to a much more aggressive threshold.
Meaning the data itself is practically screaming at you to be aggressive. It knows a surgical strike was never historically viable. It's telling you, don't try to thread the needle, don't try to be clever, just get out of the market entirely when things get even slightly bumpy.
Yes, exactly. But there is one final blow, the fourth test, which is called White's reality check. You see, we didn't just test one strategy in a vacuum. We tested 75 total strategies.
75.
We looked at combinations of different basic volatility models, our 30-feature model, different probability thresholds, and different transaction costs.
And when you take 75 shots at the target, you have to penalize your results. You have to account for data snooping, because the more times you try, the more likely you are to just hit a bullseye by accident.
And when we apply White's reality check to account for all 75 of those attempts, the most aggressive, bunker-style strategy actually survives. It passes the strictest statistical bar for significance.
Okay, well, that sounds like a massive victory for the model. It actually survived the gauntlet.
It survived with a massive catch.
Uh-oh.
That survival only happens at the aggressive threshold, and it only happens if we assume absolutely zero friction, 0 basis points of transaction costs.
Wait, so if you pay anything at all to trade...
The moment you introduce the friction of reality, just 5 tiny basis points of cost for moving your portfolio in and out of the market 50 times a year, not a single strategy out of the entire 75 suite passes the statistical significance bar. Not one.
Here's where it gets really interesting. Let's look at the puzzle we've built here. We established early on that the model is undeniably smart. The accuracy score is 0.747. It has real, measurable predictive power.
It does.
It knows when volatility is coming, but it completely fails to reliably make you wealthier as a true crash predictor once you introduce real-world costs. So, is the model fundamentally broken? Like, why did it fail?
It is not a broken model. To prove this, we just have to look at its calibration.
Right.
We took all the days where the model was the absolute most confident a crash was coming, the top 10% of highest danger days.
Okay.
In those specific moments, the model predicted there was a 7.5% chance of a severely bad day happening tomorrow.
Okay, so it threw up a warning flag saying 7.5%. What actually happened in reality on those days?
The actual realized rate of bad days was 8.8%.
Wow. Let's pause on that.
Sure.
It predicted 7.5%, and the reality was 8.8%. It wasn't just guessing the weather, it was incredibly accurate.
It was almost perfectly calibrated. The model knows exactly what it knows. The bottleneck preventing us from getting rich isn't the math. The math is totally sound.
So what's the problem?
The bottleneck is the underlying economic mechanism we keep coming back to. So if the model is highly accurate, why does it still lose money? To understand that, we have to look at a decade decomposition. We break down the model's performance decade by decade to see where it thrived and where it died.
Let's track the history then. I have to imagine this model looked like an absolute genius during certain eras. Where did it work best?
It thrived during the 1940s through the 1980s. If you look at market history, that was an era characterized by slow, grinding, prolonged bear markets. Think about the stagflation of the 1970s.
Right, so the market starts dropping, the model sees the volatility rising, it flashes a red warning, and you move your portfolio to cash. And because the market just keeps bleeding slowly, week after week, month after month, hiding in the bunker actually protects your wealth perfectly. You miss the pain, and there aren't any sudden, massive rebounds to punish you for being in cash.
That is exactly the dynamic. But then we shift our focus to the 2000s. You have the dot-com bust and the global financial crisis of 2008. From a purely mathematical standpoint, this is the exact decade a sophisticated crash predictor should have feasted.
Oh, absolutely.
It was a target-rich environment full of massive market drops. Yet, in the 2000s, the model lost heavily at every single threshold we tested.
Why? If the model is perfectly calibrated and it knows when volatility is high, why did it fail so spectacularly during the biggest, most obvious crashes of our generation?
Because the modern structure of the market changed. The 2000s featured incredibly sharp, violent crashes, but they were followed almost immediately by massive, rapid V-shaped rebounds. The model did exactly what we trained it to do. It correctly identified the high volatility danger, and it successfully moved the portfolio out of the market and into cash. But because it was sitting in cash, waiting for the volatility to officially subside, it accidentally completely missed the massive violent rebound days that immediately followed the crash.
It successfully dodged the falling knife, but it ran out of the building right as the money started raining from the ceiling.
That is the tragedy of it. A strategy perfectly fit to navigate the slow, grinding bear markets of the mid-20th century completely collapsed in the whipsaw markets of the 2000s. The model correctly identified the risk, but the act of exiting the market meant it inherently missed the cure.
So what does this all mean for you listening right now? We've gone entirely down the rabbit hole today. We looked at the seductive theoretical math that promises you a $1.6 million portfolio.
Right.
We looked at the underlying mechanism, the fact that the best and worst days hold hands in the dark. And today we built the ultimate, honest, out-of-sample modern model to see if we could outsmart that mechanism.
And if we connect all of this back to the bigger picture, the profound lesson from this deep dive isn't that data science is useless. It isn't that financial modeling doesn't work.
Right.
The lesson is that predicting the crash is fundamentally the wrong problem to try and solve.
Avoiding crashes and missing rebounds are not separate problems for an investor. They're the exact same problem. You cannot safely evict the worst days from your portfolio without accidentally evicting the best days. They share an address.
Exactly.
Now, if you want a smoother ride, if your only goal is to just sleep a little better at night and lower your blood pressure, you absolutely can use a broad volatility targeting rule. You can choose to sit in the bunker 20% of the year.
Yeah, that's an option.
But if you want more money at retirement, if your ultimate goal is absolute wealth accumulation over your lifetime, timing the market simply does not deliver the goods.
The underlying mechanism of the stock market kills the math. The tight coupling between the crash and the rebound puts a hard cap on what even a perfectly calibrated world-class predictive model can earn.
And I want to leave you with a final provocative thought to mull over on your own. If the absolute best 90-year, 30-feature mathematical model graded through a brutal statistical gauntlet proves beyond a shadow of a doubt that trying to step out of the market during turmoil actively harms your wealth.
Right.
Ask yourself, why does the entire financial media ecosystem spend 24 hours a day, 7 days a week trying to scare you into making that exact move? Who actually profits when you try to time the market? Because the data tells us one clear thing. You don't need a crash predictor.
You need a rebound predictor.
And nobody has one. Thanks for joining us on this deep dive. We'll catch you next time.